Welcome to our comprehensive guide on strategic revenue management. In this video, we'll explore how businesses make informed decisions to maximize revenue, balance costs, and set effective pricing strategy. Whether you're a student, a business professional, or simply curious about how companies optimize their profits, this journey will equip you with essential concepts and practical examples. We'll start by understanding the types of decisions businesses face, the importance of both quantity. End of this video, you'll be able to analyze short-term decisions using cost-volume profit (CVP) analysis, discuss ethical issues in decision-making, and advise on both financial and non-financial considerations. We'll also explain the theories and principles behind product pricing, evaluate different pricing strategies, and understand the importance of sensitivity analysis. These outcomes will help you approach business decisions with a strategic mindset, considering businesses constantly face a variety of decisions: strategic, tactical, and operational. Strategic decisions are long-term and shape the direction of the company, such as entering new markets or launching new products. Tactical decisions are medium-term, like adjusting pricing or reallocating resources. Operational decisions are short-term and focus on day-to-day activity. Each type requires a blend of quantitative data and qualitative judgment, understanding the time horizon and nature. Short-term decisions often ignore the time value of money and focus on immediate outcomes, such as accepting a special order or adjusting production levels. In contrast, long-term decisions consider future cash flow and strategic positioning. For short-term choices, most fixed costs are irrelevant since they will be incurred regardless. Instead, managers focus on relevant cash flow and contribution margin, making these decisions simpler but still impactful. Recognizing the distinction. Cost volume profit (CVP) analysis is a fundamental tool for understanding how changes in cost, sales volume, and prices affect a company's profit. It helps managers determine the break-even point, the level of sales at which total revenues equal total cost, resulting in neither profit nor loss. CVP analysis is especially useful for planning, controlling, and evaluating decisions related to product modification, pricing, and resource allocation. By analyzing additional CVP analysis classifies costs as either fixed or variable with respect to production volume. However, not all costs behave strictly with volume. Activity-based costing (ABC) refines this by identifying cost drivers beyond just volume, such as batch level or product sustaining activity. ABC provides a more accurate picture by assigning costs based on activities like setups or engineering changes, which may not vary with units produced. Activity-based costing. Activities are classified by how they relate to production. Unit-level activities occur every time a product is made, like using raw materials or labor. Batch-level activity, such as machine setups or processing purchase orders, happen for each batch rather than each unit. Understanding these distinctions allows managers to allocate costs more precisely, identify inefficiency, and make better decisions about batch sizes, setups, and resource allocation. Product-sustaining activity support the production or sale of specific products, such as designing or advertising a product. Facility-level activity, on the other hand, support the overall operation of the business, like building depreciation or employee training. These costs are not directly tied to production volume, but are essential for business continuity. Recognizing these categories helps managers understand which costs can be influenced by operational decisions and which are more fixed. Activity-based CVP formula incorporates non-volume driven costs, providing a more comprehensive break-even analysis. The formula is break-even point, units, barabar fixed cost plus batch level cost driver cost per batch plus product sustaining cost driver cost per product / selling price per unit variable cost per unit. This approach allows managers to see how changes in batch sizes or product enhancement affect profitability and operationally. Let's look at practical example. A company manufactures children's cycles and uses both traditional and activity-based CVP analysis. By analyzing setup costs and batch sizes, the company discovers that increasing the batch size reduces the number of setups, lowers per unit cost, and increases profit. This example highlights how operational changes, like adjusting batch sizes, can have a significant impact on both break-even points and overall profitability. Calculating setup costs, it's important to consider labor availability. If temporary labor is hired specifically for setups, those costs are included. However, if permanent labor is used and will be paid regardless, their cost is considered sunk and not included. If permanent labor is fully engaged elsewhere and additional labor isn't available, the opportunity cost of labor must be factored in. This nuanced approach ensures that only relevant costs are considered in decision-making. Reducing the number of setups or setup time increases the flexibility and utilization of machinery. Lower setup costs allow companies to switch production between products more easily, adapting to market demand. This flexibility can be a significant competitive advantage, enabling businesses to respond quickly to changes and optimize their production schedule for maximum profitability. EVP analysis isn't just for manufacturing, it's also valuable for service and non-profit organizations. Instead of focusing on units sold, these organizations measure output in terms of services delivered or beneficiaries served. By applying CVP principle, they can determine the pricing or funding levels needed to cover costs and achieve their mission, even in regulated or competitive environments. Just-in-time, JIT environment, variable costs per unit decrease or fixed cost increase as direct labor becomes a fixed cost. Batch-level variables are minimized since batch size is often one unit. CVP analysis in JIT setting focuses on optimizing engineering costs and unit-based variable costs, helping managers streamline operations and reduce waste for improved profitability. Short-term decision, also known as tactical or relevant decision, focus on choosing between alternatives with immediate impact. For cost to be relevant, it must be a future cost and differ between alternatives. Irrelevant costs, such as sunk costs or costs that remain the same across options, should be excluded from analysis. Mastering the identification of relevant costs is essential for effective decision-making. Ethics play a crucial role in business decisions. Managers must consider honesty, fairness, and the impact of their choices on all stakeholders. Ethical decision-making involves evaluating consequences, fulfilling obligations, and ensuring fairness. Companies with strong ethical cultures build trust and loyalty among customers and employees, leading to long-term commercial success and a positive reputation. Beyond financial data, non-financial information such as quality, employee satisfaction, customer loyalty, and corporate social responsibility are increasingly important. These factors ensure long-term sustainability and profitability. However, measuring non-financial metrics can be subjective and challenging, making it essential for managers to balance both quantitative and qualitative information in their decision. Still the case of Sprinter Sportswear, a multinational company that outsources production to factories in low-cost countries. Reports of child labor and poor working conditions in its supply chain raised ethical concern. Although Sprinter was not directly involved, it faced moral responsibility to address these issues. The company responded by developing a code of conduct, auditing suppliers, and increasing transparency, demonstrating how ethical consideration can drive business decisions and protect. Structured approach to decision-making involves defining the problem, identifying alternatives, evaluating costs and benefits, and considering both financial and non-financial factors. By following a logical sequence, define, identify, analyze, assess, and select, managers can make more informed and balanced decisions that align with organizational goals and stakeholder interests. Supply cost-benefit analysis to a healthcare scenario. Human Healthcare Limited considered reducing patient stay to cut costs, but this raised concerns about patient well-being and potential readmission. While the plan increased short-term profits, it risked harming the company's reputation and long-term profitability. This example underscores the importance of weighing both quantitative benefits and qualitative impacts before making critical decisions. Sourcing, or the make or buy decision, involves comparing the incremental cost and saving of producing a component in-house versus purchasing it externally. Managers must consider not only direct costs, but also opportunity costs and qualitative factors like quality, supplier reliability, and strategic flexibility. The right decision balances cost saving with long-term business objectives. In deciding whether to sell a product as is or process it further, only incremental costs and revenues after the split-off point are relevant. Joint costs incurred before separation are sunk and should not influence the decision. Managers should also consider qualitative factors like resource availability and customer preferences to ensure the best outcome. Minimum pricing is used in competitive situations, surplus capacity, or special orders. The minimum price should cover incremental manufacturing costs and any opportunity costs. This approach ensures that the company does not sell below its relevant cost, protecting profitability while remaining competitive in the market. Deciding whether to keep or drop a product line or business segment depends on whether the segment's revenue exceeds its directly traceable cost. Managers must also consider the impact on employees, suppliers, and customers, as well as opportunity costs associated with freed up resources. The goal is to maximize overall profitability while maintaining strategic relationships. Special order decisions involve evaluating whether to accept orders at prices different from normal sales. Incremental analysis is key. If the additional revenue exceeds the incremental cost, the order should be accepted, provided it doesn't negatively affect regular business or long-term capacity. Qualitative factors, such as customer relationships and market positioning, should also be considered. When resources are limited, such as machine hours or material, product mix decision should be based on contribution per unit of the limiting factor. Linear programming can help determine the optimal combination of products to maximize overall contribution and profit, ensuring the most efficient use of scarce resources. Revenue management is closely tied to pricing policy. A well-defined pricing policy aligns with corporate objectives and market conditions, ensuring long-term survival and profitability. While costs are important, factors like consumer demand and competition often play a more significant role in setting prices. Strategic pricing policies provide incentives for innovation, resource optimization, and market balance. Pricing is the only element of the marketing mix that generates revenue. It's a critical determinant of profitability and market share. Customers compare prices across brands, making competitive pricing essential. Effective pricing decisions require understanding the interplay between product, promotion, place, and price to achieve marketing and organizational goals. Pricing decisions are influenced by both internal factors, such as corporate objectives, cost structure, and product characteristics, and external factors like market composition, buyer attitudes, competitor pricing, and government regulation. Balancing these factors ensures that pricing strategies are both competitive and aligned with the company's long-term vision. The core principle of product pricing is to set a price that maximizes profit, where marginal revenue equals marginal cost. This involves analyzing demand and cost function, understanding market structure, and considering the product's life cycle. Effective pricing strategies balance profitability with market competitiveness and customer value. Pricing strategies vary across market structures. In perfect competition, firms are price takers and must accept market prices. In monopoly, firms can set prices but must consider demand elasticity. Monopolistic competition involves many firms with differentiated products, while oligopolies feature a few dominant players who must anticipate competitors' reaction. Each structure requires a tailored approach to pricing for optimal results. Oligopolistic markets often rely on non-price competition, such as quality improvement, advertising, and loyalty programs, to avoid destructive price wars. Pricing strategies may include predatory pricing, limit pricing, or cost-plus pricing. Firms must carefully analyze competitors' potential reaction before making pricing decisions to maintain market stability and profitability. Effective product pricing involves more than just covering costs. It requires understanding market demand, competitive dynamics, and customer perception. Principles like price customization, sensitivity analysis, and value-based pricing help companies set prices that maximize both profit and customer satisfaction, adapting to different product types and market conditions. Price customization tailors prices based on product features, customer demographic, or purchase timing. Price sensitivity measures how customers react to price changes, influenced by factors like uniqueness, substitutes, and perceived quality. Understanding these concepts enables businesses to optimize pricing for different segments and maximize revenue. Structured pricing process involves setting objectives, estimating demand elasticity, calculating costs, assessing customer demand, analyzing competitors, selecting a pricing method, and periodically reviewing outcomes. This systematic approach ensures that pricing decisions are data-driven, competitive, and aligned with business goals. Pricing new products is challenging due to uncertain demand. Companies may use experimental sales in different markets to determine optimal pricing. New products can be revolutionary, evolutionary, or me too, each requiring a different pricing strategy. Premium pricing for innovation, demand-based pricing for upgrades, and market-based pricing for imitation. Skimming pricing sets high initial prices to maximize early profits from less price-sensitive customers, gradually lowering prices over time. Penetration pricing uses low initial prices to quickly gain market share and discourage competitors. The choice depends on demand elasticity, production scale, and competitive threat, with each approach offering distinct advantages. Existing products can be priced using cost-based, competition-based, value-based, or psychological methods. Cost-based pricing adds a markup to production cost, while competition-based pricing aligns with industry averages. Value-based pricing focuses on customer perception, and psychological pricing leverages consumer behavior. Selecting the right method depends on market conditions and business objectives. Cost-based pricing methods include markup pricing, where a standard margin is added to cost, and target rate of return pricing, which sets prices to achieve a desired return on investment. These methods are straightforward but may not fully account for market demand or competition, making them best suited for less competitive or customized markets. Competition-based pricing sets prices in line with industry standards, while value-based pricing considers the perceived value to customers. Value-based pricing can help avoid price wars and focus on delivering unique benefits, but it requires strong market research and understanding of customer preferences. Service pricing differs from product pricing due to intangibility, variability, and perishability. Services may be people processing, possession processing, mental stimulus, or information-based. Emerging business models, such as disruptive or sustainability-focused models, require pricing strategies that reflect social, environmental, and economic considerations, especially in price-sensitive markets. Sensitivity analysis tests how changes in key variables, like demand, cost, or market conditions, affect pricing decisions and profitability. By systematically varying assumptions, managers can identify risks, opportunities, and the robustness of their pricing strategy, ensuring better preparedness for market fluctuation. During recessions or periods of excess inventory, firms may temporarily price below total or even marginal cost to maintain operation, prevent asset deterioration, or clear perishable goods. However, such pricing should be limited in duration and scope to avoid long-term profitability issues and regulatory concerns about predatory pricing. Ethical pricing goes beyond legal compliance, ensuring fairness and transparency. Issues like price fixing, bid rigging, and unjustified price hikes can damage reputation and customer trust. Non-financial considerations, such as brand image, product quality, and societal impact, are equally important for sustainable pricing strategy and long-term success. Strategic revenue management requires a holistic approach, balancing financial analysis, ethical consideration, and non-financial factors. By mastering tools like CVP analysis, understanding relevant costs, and applying structured pricing strategy, businesses can make informed decisions that drive profitability and long-term growth. Remember, the best decisions are those that align with both organizational goals and stakeholder interests, ensuring sustainable success in a dynamic